Trump makes a deal with China, sort of. The first Treasury report and inflation data since tariffs were announced gets released, and more issues in the bond market. So many have probably heard, but Trump announced a sort of a deal. It's not really a deal, it's just an agreement to start talking with the Chinese on trade. And we can see here with S&P 500 that the market is taking it extremely well. The S&P 500 is now well above the level heading into so-called Liberation Day, which is here. SPY is showing incredible strength. It left this huge gap here. There are also gaps that we kind of noted appear to have just gotten left behind. I think that this rally is probably starting to get a little bit overbought. RSI is starting to indicate that, especially on like the 4 hour, the 8 hour. This rally is getting a little ahead of itself, in my opinion. Tariffs, the average tariff rate for many decades from the US on the rest of the world was 2%. And currently, as a weighted rate, the average weighted rate, depending on how much trade we do with each country, is about 18.5% last I checked. And that's even including this reduction in the tariff rate on China all the way down to 30%. So even with everything that's been announced and reduced and paused, we're still looking at a tariff rate that is significantly higher than anything that the U.S. has gotten used to for many decades. So I think that there's clearly a lot of optimism in the S&P and risk assets, but it does appear probably a little bit overblown, probably overshot to the upside, as is normal with markets. We overshot a bit to the downside, and in my opinion, we probably are starting to overshoot to the upside. So, in terms of going to go make new all-time highs, I'm not convinced that that's likely. The dollar. So something interesting with the dollar. The dollar. Here we see I'll put the green line where Liberation Day was. Here. So the dollar is still notably weaker. We've been noting this. When the S&P moved back up to the pre-Liberation Day level, we noted that there were two main things that were actually had made a significant move. One was the dollar, which was significantly weaker. I think at the time we made that video, it was about 3% weaker, and currently it's about 2.5% weaker than Liberation Day. And the other is oil. So oil is still notably weaker. I think it's closer to 10 or 11% weaker. Yeah, so like 11.5% weaker. This is indicating that, despite all of the rollbacks and the so-called deal that was made with China and all this stuff, despite all this, in terms of growth for the global economy, the oil market is still indicating worse, more negative growth outlook for the global economy. And we can see this too with the kind of global developed market yield that I use. So I take an average. Here is Europe, and we can see that since Liberation Day, Europe is still lower in terms of their average 10-year rate. Now, it's marginally lower. It'll probably end up back at that pre-tariff level. But on the other hand, we have the U.S. 10-year, which is moving in the wrong direction. So, all my videos that I was doing during this week here when Treasury yields were ripping to the upside, making that 60 basis point move here, all those videos and all the chaos, we're right back to the levels that the 10-year yield was trading at the day that Trump reversed course on tariffs. We are right back to 450. And so, he already paused tariffs. That's why yields started to come down here. That was the big 90-day pause. And so they were able to get yields down marginally. And then there was a bit of some bullish activity in the Treasury market, kind of in general here, bull flattener that we had. But we're moving right back in the wrong direction. So the 10-year is right back where it was trading the day that he was forced to do the 90-day pause. This is on fiscal concerns, and we can see that by looking at the break evens, which we'll look at now. Here's the 5-year break even, and we can see that the market is not worried about inflation. The 5-year break even is down 16 basis points since Liberation Day, and the 10-year break even is down marginally, but still down since Liberation Day, so down about 4 or 5 basis points. Um, so it's not inflation because the market expectation for inflation is actually lower than it was leading into Liberation Day. So what is it? Well, it's what we call the real rate, the real yield. And so here we see the 10-year yield, and this is just the nominal 10-year yield we were looking at before, and then you subtract the 10-year break even. So you take the nominal 10-year yield and you subtract what the market is expecting inflation to be. That's what that 10-year break even inflation swap is. And so when you do that, what you see is that since Liberation Day, the 10-year real rate of return, this is basically the premium that the market is demanding in excess of expected inflation is higher. I made a post a couple days ago. At that time, it was 33 basis points, but it looks like currently 37 basis points. So to me, this indicates kind of fiscal concerns, which is a perfect segue into. So we got inflation data today, and this is the CPI rate. I'm not sure why it's not labeled properly, but this is the headline CPI inflation rate. And we can see that it actually printed the lowest level since February, March of 2021. So inflation, like we've kind of been talking about, we have not been worried about a huge inflationary wave. This continues to play out. Inflation is now the rate of inflation is now the lowest, going back all the way to early 2021. And granted, this report had the ability or the potential to show inflationary impacts from tariffs. Of course, we've talked about the inventory front loading a lot, and that dynamic is still really important. Where it might take a couple months for that particular inflation to start working its way in. But there was, this particular inflation data did include a couple weeks post Liberation Day, post tariffs. And we don't see any notable increase in inflation yet. Now, it's always possible that a week, I'm sorry, a month or two from now, as some of that inventory dries up and that was front loaded, ahead of the tariffs, as that starts to dry up and new orders start coming in, it's always possible that inflation does pick up. We have always said for the past year and a half that inflation is very unlikely to head back to 1 or 2%, and that we're probably just kind of in a structurally higher inflation sort of regime, closer to 3%. And this is due to many things, but mainly the fiscal. And so on that note, some fiscal data, the Treasury releases fiscal and balance sheet data, and what here we see here, this is the kind of overall budget that they update. And what we can see is that on a net basis, like taking everything into account, we are running a deficit that is 23% larger than this time in 2024. So the rate of increase is significant in terms of the deficit. We have been noting this kind of deficit issue for a while. That despite all of the Trump administration's efforts and you could say desires with Doge and all this kind of thing, the deficit is actually higher than it was this same time in 2024. And that's unlikely to, what we said was that was unlikely to meaningfully improve. And with this data, we can see the deficit is actually worse. Now, with this data, there was actually some good news, I guess you could say, which was the US, we started to see some of the tariff impact. And the US collected $16 billion for the month of April in tariffs. 16 billion. Now, if you annualize that, that works out to be about 205 billion, if my math is correct. And interestingly, that is the total amount that the bottom 70% of income earners pay every year in income tax. So if we are able to keep up this $16 billion a month in tariff revenue, we theoretically they would be able to eliminate the income tax for the bottom 70% of income earners. And the last time that I did kind of a calculation and looked into it, to fall into the bottom 70, you have to make I think it was between 95,000 and 105,000. So as long as you make kind of that amount or lower, you technically fall in the bottom 70% if you're single. I forget what it was for married, but yeah, with $16 billion if that continues, it would be theoretically enough to eliminate the income tax for the bottom 70%, which I think, would be absolutely incredible. I think that they need all the help that they can get. It's unfortunate that we've kind of, forgotten that the American economy is not just the top 10%, but that, that would be a step in the right direction, in my opinion. And I think with these budget issues, with these fiscal issues that we just went over with the Treasury data, but also there's this bill in Congress, this tax bill, and a couple interesting things that I think are notable about it, which is it's not going to meaningfully improve the deficit. If anything, they are asking for $4 trillion of debt ceiling increase, right? So this whole balanced budget or even paying down the debt, like all that nonsense, clearly not coming to fruition. It was never going to happen, in my opinion. But it is stimulatory, and I think that this is what the bond market is kind of starting to get a little upset about. I think the bond vigilantes who theoretically hold the power to really call the shots here. I think that this move higher in the long end of the yield curve is starting to kind of knock on the door and remind Congress, hey, we still exist. If you try to propose too much cuts, too much revenue cuts, and not enough spending cuts, if it looks like your bill will increase the deficit significantly, well, what does that mean? That means more bond supply. More of these 30-year bonds must be issued by the Treasury. That is higher supply. And higher supply with, call it, constant demand, that means higher rates. Now, constant demand is kind of the best case scenario, in my opinion, because we have, an administration that kind of, I think, accurately understands the issues with the capital account surplus and how it drives this overvaluation of the dollar, causes the trade deficit. I think they understand that. But that being said, you cannot attack that capital account surplus by the kind of chaotic tariffs and the executive order back in February that targeted foreign capital. I think it was Chinese capital specifically. But, all those sorts of policies are clearly designed to target this capital account surplus, which, arguably, you could make the argument that that drives the trade deficit. But, the other side of that coin is that there's no free lunch. And if you start to disincentivize foreign holdings of dollar and dollar denominated assets, that demand that I was assuming stayed constant, that demand might actually be falling in the face of an increase of bond supply to cover an increase in the deficit. So I think that is what the bond market is really kind of is the message that it is sending, right? And I think that this is why real rates are headed higher. Now, where they go from here, what is the next lever that they can pull? That's a good question because, it seems to me that in terms of the tariffs and all the trade stuff, like, seems to me that, most of the levers that Trump could have pulled have kind of been pulled. So, I don't know. I can't see many more levers on the trade front being pulled, which kind of, brings us to the fiscal. And look, as much as I think tax cuts for middle and working class people are good, if it's going to increase the deficit, the bond market will send the signal with higher rates. Their displeasure or their anticipation of higher bond supply. And so, I think ultimately there is a level. I'm not sure where this level is. This is the 10-year Treasury. There is a level here that could theoretically, get Congress to capitulate and make sure that the bill that they write and bring is more budget neutral. I don't know where that level is. The only thing I would say with some certainty is that it's probably not too far away. I mean, remember, this was the level that got Trump to do the 90-day pause. We are trading right back there. And tariffs were part of Trump's whole core kind of policy thing. It was kind of his whole thing, and the bond market got him to pause and kind of reverse on one of his core policy objectives. So, yeah, it's pretty powerful what it can do when it wants to. James Carville, famously said, "If I ever die, I want to come back reincarnated as the bond market because you have power over everyone." Or something to that effect. So yeah, so I think those are a couple things to keep an eye on. The deficit is significantly worse. This is not bullish for bonds. We have the kind of capital account side that I believe they're targeting. I would say with this China deal that it's interesting the amount of my thoughts on China in particular and this particular kind of framework that has been developed. It's interesting the amount of discussion that I've heard about the need for China to also restructure their economy. We have talked about the kind of American economy and how it's structured, where basically, we run these twin deficits, which means the only thing our nation can accumulate is debt. Well, on the other hand, China runs kind of the opposite. They run this overcapacity, subsidized export sort of model where they accumulate huge amounts of wealth, from the rest of the world, and for the past 10 years or so, their foreign exchange reserves have not actually reflected that. Instead, it's gone into stuff like the Belt and Road Initiative. Well, anyways, China, they have been speaking even within the kind of party. Party leaders have been saying for many years now that in China they are aware that they need to restructure their economy much more towards domestic consumption, just as the U.S. needs to restructure our economy away from so much imported consumption and much more towards kind of back in the direction of actually being a net productive economy again. So it's interesting that a lot of that talk is starting to surface. How willing the Chinese will be to actually, this being the time. Okay, you guys have been talking about it for many years now that you want to do this. We want to do it as well, right? Scott Bessent could be saying, we want to restructure as well. We import far too much. It's only, running up the debt, twin deficits, right? All the problems. I don't know if that conversation will work. I don't know if now is the time. I don't know if China is ready to kind of make true to their words, which they've been saying about their desire to restructure toward domestic consumption. I'm not sure. But I think one thing that really is interesting about all the China deal stuff is I've heard a couple times where people involved in that discussion, involved in that deal, were asked about currencies, and they always refused to answer the question. So I still think that I've been saying for a long time, tariffs alone were never going to solve the trade deficit. You need to address the currencies and all the structural issues with not just the dollar, but also on the other side, the Chinese yuan, and other currencies as well. And so I think that would be the next stage that, if they are serious about make America great, reindustrialize, all that kind of thing, I think that will be the next stage. all of, restructuring either the American economy or the Chinese economy is not going to be a week long thing. It's not going to be a month long thing. It's not even going to be a year long thing. I mean, we're talking many years that this sort of kind of momentous restructuring would play out, or that it would take to play out. And so I would encourage everyone try to keep like the big perspective on it, on all this stuff. I know day to day there's so much news, so much headlines driving everything. But I think it's important to sometimes take a couple steps back and look at where we really are. Like I said in the beginning, the average tariff rate is still significantly higher, like 8x higher than it was for many decades. So, in terms of like the S&P 500, I don't know that it should be so much higher than it was on Liberation Day. I don't know. Call me skeptical, but this rally is probably getting a little bit overbought. I would also point out that we are higher now for the year. So the start of the year was right here, and we are now ever slightly higher than we were on January 1st. The S&P, I think the Nasdaq is now in a bull market off of these lows. So Nasdaq tech stocks are back in a bull market. S&P is green year to date and significantly higher than Liberation Day. I think that within the next month or so, we could see a pretty significant pullback. So that's just kind of how I'm seeing it. Remember, I think, as I've been saying, the dollar is key to keep an eye on as you're trying to evaluate Trump and all these kind of trade issues, and certainly the fiscal issues that are starting to surface. So hopefully that was helpful. Should be noted, gold is down and not pausing the pretty epic run that it was having. So it appears to be kind of developing a range here. It'll be interesting to see if that range breaks down. But the fact that it hasn't really pulled back hard per se, and instead just kind of started to develop a range up at these levels, I think is notable. And of course, Bitcoin has been showing tremendous strength as well, back above 100K. It has a lot of catching up to do in terms of Bitcoin over gold. We've been talking about this chart. Bitcoin has a lot of upside to catch back up to gold, but versus the Nasdaq, it continues to be on this kind of relative trend of outperformance. So that's always good to see. But anyways, hopefully that was helpful. Just my quick thoughts on everything that's developed the past couple days.